Sticking with the market, the S&P 500 and NASDAQ on pace to snap two-day losing streaks, and the Dow tracking for its second down day in a row ahead of the Fed decision. Joining us now is the Kobeissi letter editor-in-chief, Adam Kobeissi. So, Adam, good to see you. I want to stick with what Taylor just said, okay? Some people are saying the rest of the market needs to start performing for this rally to continue, not just the 5 stocks that have been carrying it right now. But you say all-time highs will continue anyway. Why?
Yeah, thanks for having me on the show. I think it's a really interesting market we have right now where the Magnificent Seven actually reflect a record share of over 30% of the market. I mean, that's literally 7 stocks of the S&P 500, sorry. That's 7 stocks that are effectively driving price action. But the thing is, those 7 stocks, the AI trend has been very strong. I think the tech stocks as a whole have been strong, and you're actually seeing pretty solid earnings growth. You saw almost 6% in blended earnings growth in Q1. So right now, it's kind of, we're in the camp where, and we've been saying this all year, you don't really want to fight this market because when it keeps running, the trend is strong, momentum is strong. Even dips of 2% are being bought rather quickly, even on an intraday basis. And we believe that fighting that trend right now is just not profitable. And we actually think the S&P 500 is going to head towards 5,400, even 5,500 pretty quickly here.
Adam, is that prediction based on another prediction you have that there's still 2 rate cuts in the cards from the Federal Reserve, which an increasing number of market analysts and economists don't think that could happen on this planet because inflation is still running based on CPI. We get it later this week for last month, but it's still running annualized for 3 and 6 months at north of 4%. The Fed would never cut rates with inflation running at 4%.
Yeah, that's a great point. And actually, our thesis factors in just 1 rate cut this year. We may see 1 to 2 cuts is what we're expecting. We may see 0 depending on what happens with the data. But look, the S&P 500 since January has priced out 4 interest rate cuts, even 5 interest rate cuts in some cases. And the S&P 500 is up 12% year to date. So this notion that markets can't rise while rate cuts are priced out or even more hawkish policies priced in has been proven wrong. And I think what we're seeing here is that momentum is just so strong. Risk appetite is so strong. We might have record high levels of risk appetite in this market. I mean, you have crypto all-time highs. The meme stock rally is back. Tech stocks are being bought. I mean, and we've had every single reason to fall this year, and we're just not falling. So in our view, and we've been telling our subscribers this, it's not the right time to fight the market.
Talk to me about the Fed, though, and inflation. Are we still committed to a 2% target, or a lot of economists thinking 3 or 4% would help us avoid a downturn?
Absolutely. I think the Fed is going to remain highly committed to their 2% target. I mean, since the Fed started raising rates and then now keeping them higher for longer, there's been every single Fed meeting, it feels like people want to say, yeah, maybe we'll do a 2.5% long-term target, 3% long-term target. The Fed has made it clear, and they seem to be pretty unified on this, that 2% is their long-term target here. And that's actually why we are in the higher for longer camp. And markets are kind of just readjusting now, and that higher for longer means higher stocks for longer along with interest rates, even if consumer sentiment is dampened. And there's actually a poll that came out the other day. 55% of Americans believe we're in a recession right now when we've actually had 7 straight quarters of positive GDP growth. So to look around and say it feels like the economy is weak and consumer sentiment is weak, that could be 100% true, and higher interest rates could be here to stay. But that doesn't necessarily mean that the stock market is the economy. And I think that's a very key theme that many people are learning this year.
Adam, good stuff. Good to see you. Thanks for being with us.
Thank you. Thanks for having me.